Hey guys, today we're going to discuss an important yet sometimes overlooked aspect of property investment, depreciation. Over the next few minutes, we'll explore what depreciation is, how it works for investment properties, and the potential tax benefits. Let's get started. So first of all, what is depreciation? Now, depreciation in the context of property investment refers to the decline in the value of a property's fixtures, fittings, and in some cases, the building structure itself over a period of time. For tax purposes, the Australian Tax Office allows investors to claim deductions based on this gradual wear and tear. Now, effectively, what this does is it provides you with a non-cash, paper-based deduction to decrease your taxable income. Now, there are two main categories of depreciation that you can claim on residential and commercial investment properties. The first is Division 43, also known as Capital Works Depreciation. This covers the structural elements of a building, such as the walls, the floor, and the ceiling. Generally, this form of depreciation is at a set annual rate, often 2.5% over 40 years from the date of construction. However, if it's a particular type of commercial property, such as a warehouse or industrial property, that could be 4% over 25 years. Now, varying rates will actually apply depending on when the building itself was constructed, so that should be checked. Now, Division 40 is property, plant, and equipment depreciation. This relates to items within the property that are easily removable and subject to regular wear and tear, such as carpets, appliances, air conditioning units, and light fixtures. These items depreciate at a different rate based on their effective life. Each of these effective lives are defined by the ATO. Now, when we're thinking about depreciation, we have to understand, how do we actually claim depreciation? Claiming depreciation isn't as simple as guessing a percentage off the top of your head. Typically, what you'll need to do is engage with a professional called a quantity surveyor. Now, a quantity surveyor is a professional who prepares a depreciation schedule. A depreciation schedule will outline various elements such as the estimated construction costs for capital works, the value and effective life of each plant and equipment item, the annual depreciation claim available over a set period of time for you, and then once you've got this schedule, you provide it to your accountant or tax agent, and they'll utilize it to include in your tax return and actually benefit from the depreciation each year. Now, when we think about depreciation, we can look at an example of the impact of depreciation on tax. So let's illustrate how this might impact your tax position. Imagine in this scenario, we have a property with a purchase price of $500,000, annual rental income of $20,000, rental expenses such as interest, maintenance, and insurance of $22,000, and a depreciation claim for the year of $5,000. Now, the impact on taxable income is as follows. Without depreciation, your net rental position is a $2,000 loss, $20,000 minus $22,000. With the $5,000 depreciation claim hour, your taxable loss increases to $7,000. This extra $5,000 reduces your overall taxable income from other sources, for example, your salary, lowering your tax bill. Essentially, you're not paying an extra $5,000 in cash expenses. It's a non-cash deduction, yet it still improves your tax outcome for that year. In this scenario in particular, it takes us from having a cash and tax loss to only having a tax loss while having a cash profit. Now, a couple of considerations for depreciation. The age of the building matters. You can generally claim depreciation works on capital works for a period of 40 years. So if your building is older than that, you won't have any capital works depreciation allowable unless there have been renovation expenses incurred in the last 40 years. It's also important to understand that ownership structure has an impact on depreciation. The split of the ownership structure will be distributed to each of the parties based on their ownership, and therefore depreciation is prorated across ownership percentages. It's also important to note that used plant and equipment, i.e. second-hand plant and equipment, cannot be depreciated any longer. It needs to be purchased new, otherwise that particular line item for depreciation is not applicable to you. Depreciation can be a very powerful tool when trying to build an investment property portfolio, as it assists in providing a cash flow supplement to support you during periods where the property itself, standing on its own 2 feet, isn't actually cash flow positive. Another thing to bear in mind, however, is depreciation is taken off of the cost base of the property when you actually go to sell it. This means that if you depreciate a property by $100,000 over the period of, let's say, 10-year period, when you go to sell that property, the cost base, in this example, let's say $500,000, is considered to be $400,000. That means potentially more CGT on the back end when you go to sell this property. Now, there are some ways to manage this, but it can get a little bit complicated. So if you do have an investment property and you want to understand how you can mitigate your tax and improve your cash flow, I suggest you contact us for a free consultation. We're happy to consult anyone that's got a property and wants to learn a little bit more about depreciation schedules and how they can actually decrease tax. As always, if you have any comments or questions, leave them in the comments below. We'll get to them as quickly as we can.